There's a very tempting idea that quietly dominates retail investing. It feels rational, safe, and almost foolproof. And because of that, it keeps millions of disciplined, hardworking people stuck in a cycle of mediocre results. That idea is called passive income. You've seen it everywhere: the YouTube thumbnails, the Reddit posts. The promise is simple and comforting. Buy a stock, hold it forever, and every quarter, money shows up in your brokerage account like clockwork. In your mind, you're relaxed on a beach in Thailand or tucked away in a mountain cabin, casually paying your bills while those payments roll in. Your original investment stays untouched, maybe it even grows. It feels effortless. It feels like interest from a savings account or rent from a perfect tenant who never complains. You convince yourself that as long as you don't sell shares, you're not touching your principal. The dividend feels like a bonus, a reward for patience and loyalty. This belief is the foundation of dividend growth investing, a corner of finance that treats selling shares like heresy and worships yield as salvation. But here's the uncomfortable reality. This belief may be one of the most expensive mental mistakes in modern investing. Dividend investors hate hearing this, but dividends are not free money. They are irrelevant. A dividend is simply a forced sale of part of your own asset. When a company pays you a dividend, it's moving money from one pocket to the other, while the IRS takes its cut in the middle. I spend far too much time breaking down the comforting lies we tell ourselves about money. If you constantly track dividend yield, filter for dividend aristocrats, or feel guilty about selling shares to cover expenses, this message is meant for you. Today challenges the entire passive income narrative. We're diving into dividend irrelevance theory, a Nobel Prize-winning concept developed by Merton Miller and Franco Modigliani. It proves that dividend payments do not increase your wealth by even a single penny. We'll examine what really happens on the ex-dividend date, why forced payouts are tax inefficient, and why selling shares from a growth company is mathematically identical and often superior to collecting dividend checks. This is the explanation passive income gurus avoid. To understand why the dividend dream collapses, we need to strip away emotion and examine the mechanics. Most people think of stocks as magical bonds that generate income, but a stock is ownership in a business. Let's make that concrete. Imagine you own a small company, a lemonade stand empire with exactly $1 million in cash sitting in its bank account. You own 100% of it. The business is worth $1 million because of that cash. Now, you decide to pay yourself a $100,000 dividend. You move that money from the company's account into your personal checking account. Are you richer? No. You now have $100,000 in your hand, but the business is worth only $900,000. Your total net worth didn't change. You just moved money between jars labeled business and personal. That's exactly what happens in the stock market. On the ex-dividend date, the stock exchange automatically reduces the stock price by the dividend amount. If a stock is trading at $100 and pays a $2 dividend, it opens at $98 the next day. The market knows the company is $2 per share poorer. Nothing magical happened. The company liquidated part of itself and gave it to you. It's the same as withdrawing cash from an ATM. You have cash in your hand, but your account balance drops. You wouldn't celebrate an ATM withdrawal as passive income, so why celebrate a dividend? The answer lies in psychology. Our brains separate capital and income. We see the stock as the golden goose and the dividend as the golden egg. Selling shares feels like killing the goose. But in a world of zero commission trading and fractional shares, there is no mathematical difference between earning a 4% dividend and selling 4% of your shares in a company that pays no dividend. In both cases, you generate 4% cash flow. In both cases, your remaining investment value drops by 4%. The difference is emotional. Dividend investors feel safe because their share count stays the same, even though the value falls. Growth investors feel uneasy because they own fewer shares, even though the remaining shares are more valuable because the company reinvested its profits. This idea is known as the homemade dividend. You can create any yield you want by selling a small portion of any portfolio. You don't need a CEO to do it for you. And letting the CEO do it often creates a tax nightmare.
When a company pays a dividend, you have no control. You receive the money whether you need it or not. In a taxable account, you owe taxes immediately, even if you reinvest the dividend. Compare that to selling shares. You choose when to sell. You can sell shares with the highest cost basis to reduce capital gains. You can wait for a low income year, or you can choose not to sell at all and allow your money to compound tax deferred. This flexibility is a massive advantage, one dividend investors give up voluntarily. By chasing yield, you introduce a tax drag that compounds negatively for decades, reducing total returns compared to a strategy focused on capital appreciation and efficient sales. There's another harsh truth. A dividend often signals that a company has run out of growth ideas. When companies like Apple and Microsoft were in their hypergrowth phases, they paid zero dividend. Management believed that $1 reinvested internally could become $5 later. They respected shareholder capital by keeping it inside the business. When a company starts paying high dividends, management is often saying they have no better use for the money. No expansion, no acquisitions, no innovation. Many high-yield stocks are value traps, businesses in shrinking industries like tobacco or legacy telecoms that are slowly liquidating themselves. You're buying a melting ice cube because you like the puddles it leaves behind. Never confuse dividend yield with total return. Total return is price appreciation plus dividends reinvested. If a stock pays a 10% dividend but loses 5% in price every year, your total return is 5%. If another stock pays no dividend but grows 10% annually, it wins. Retirement is funded with equity, not yield. If you have $1 million of a growing stock, you can sell 4% each year and still grow your portfolio. If you have $1 million of a declining dividend stock, your principal shrinks. The obsession with dividends causes investors to underperform the market just to feel emotionally comfortable. The ultimate proof is Warren Buffett. He enjoys receiving dividends through Berkshire Hathaway because the company pays a lower tax rate than individuals, but Berkshire itself has never paid a dividend. Buffett understands that dividends remove capital from the compounding engine and trigger taxes. He believes retained earnings create more value through stock appreciation than distributions. If you admire Buffett's words, you should also study his actions. To escape the dividend trap, stop seeing dividends as income and start seeing them as forced partial sales. Shift your focus to total return. Build a diversified portfolio of the best companies in the world regardless of dividend policy. When you need cash, sell small portions strategically. This approach gives you tax control, keeps you invested in growth, and aligns your strategy with math instead of fear. Stop chasing the illusion of free money. Focus on growing the entire pie, not just nibbling at the crumbs. If this challenged how you think about investing, hit like. Follow for more ways to break financial myths. Ignore the noise, trust the math, and build wealth intentionally. I'll see you next time.